Good morning, everyone. Welcome to today's Phillip Securities Research Morning Call. Today we have several stock counter updates. For results, we have AMD, Disney, Alphabet, SGX, OUE REIT, Keppel, and First Street. For Phillip on the ground, today we have CICT. For our macro and sector outlook, today we'll be presenting on the usual SG Weekly for week 7. And there's also technical pulse for S&P 500, Bitcoin ETF, as well as software ETF IGV. Kindly note that there will be no morning call next Monday, 16 Feb, in lieu of the CNY half day. Yep, so without further ado, this is the disclaimer slide. Any information presented is solely for educational purposes and should not be treated as financial advice. Okay, so now I'll be presenting on AMD's fourth quarter results. Last week they released their fourth quarter results and we also released our report. So for AMD's fourth quarter results, the revenue is within our expectations. Fourth quarter PATMI beat our expectations because of higher data center GPU as well as CPU sell-through. For the positive for AMD, data center segment growth accelerated for the second consecutive quarter. As you can see under revenue itself on the table on the left-hand side, data center revenue increased by 39% year-on-year. Previous quarter, it was 22% year-on-year, so it's a big acceleration. And in terms of margins-wise, as you can see in the chart at the bottom left-hand corner, data center operating margins also reached the highest since first quarter 2022. And the blue color lines shows the data center revenue trailing 12 months. So there's a big acceleration there. This is because the AMD's MI350 GPU has been ramping since June last year. Yeah, so there's a very it is currently still ramping the MI350 GPU. In terms of AMD's client PC segment, they are still gaining market share from Intel. As you can see, as you can see on the left, client PC revenue increased by 34% year-on-year. This is because of there's still very high demand for AMD's Ryzen PC CPU. In contrast, Intel's PC revenue is down 7% year-on-year. So we do think that it is still gaining market share from Intel. In terms of AMD's negatives for this quarter, the fourth quarter OPEX increase outpaced their revenue growth. As you can see, OPEX in the left-hand side, it increased by 42%. It outpaced revenue growth of 34%. So this is because AMD invested higher into R&D for the next generation GPU itself. And they also had higher employee compensation. So going forward, AMD did guide that revenue growth will outpace OPEX in the next year itself as the GPUs ramp. So in terms of guidance, AMD guided that for this year itself, second half, Helios and MI450 GPU, which is the next generation GPU, will be launched. MI500 GPU, which is the next generation GPU, is on track to launch in 2027. And AMD did mention that they are positioned for more than 60% annual data center revenue growth over the next 3 to 5 years because of the Instinct GPU as well as EPYC CPU roadmap. So I think that this is a very positive guidance because for the fourth quarter itself, data center revenue increased by 39%. So for AMD to guide that annual data center revenue can grow more than 60%, it is a very positive guidance. And I think in terms of our outlook, I do think that AMD has a clearer GPU roadmap as compared to NVIDIA, because NVIDIA only guided Vera Rubin GPU to start shipping by this year. But NVIDIA did not really guide any details beyond 2027, unlike AMD. So for AMD itself, we upgrade to buy from accumulate, and our target price is unchanged at $280. AMD after the recent drop, its PE is cheaper than NVIDIA, currently trading at a 31 times forward PE as compared to NVIDIA's 39 times. Yeah, so that's all from my end. I'll hand over the time to Helena. Thanks.
Thank you. And I'll be covering the Walt Disney, who released results last week. Next slide, please. So they're both first quarter revenue and adjusted PATMI were in line with our expectation. They were at 25 and 26% of our FY26 estimate. So what is something that we really like about Disney is they have really strong IP strengths, and that translates into multi-platform monetization. So in 2025, they generated a global box office of above 6.5 billion US dollar, which they took the number one position again, which is the ninth time out of the past 10 years. So they have flagship titles such as Zootopia 2 and Avatar. So both reach 1.7 billion and 1 billion global box office. So what really put them in a good spot is it's not just the box office. They're also going to be able to integrate the IP and feed it into the streaming and the park visits. And because of these two titles coming out, the Priya, Zootopia, and the Avatar titles are generating now 1 million first streams upon the platform release and hundreds of millions of incremental viewing hours on Disney Plus, which is their streaming channel. And also, their IP-led attractions like Zootopia Land and Shanghai Disneyland is also driving a high proportion of destination-specific visitations. So this is what we really like about them. It's not just the global box office. They're able to transform the monetization into other parts of their business as well. And the second thing we like about them is their streaming business has improving margins. So it continues to show profitability. It drives 12% year-on-year revenue growth and more than 50% year-on-year growth in segment earnings. The growth was driven by a combination of pricing actions and improved plan mix, and also a strong uptake of bundled offers, the Duo, Trio, and Max bundle, which management noted it's driving higher ARPU and also lower churn. Advertising also continued to scale, benefiting from a growing ad-supported subscriber base and improving demand. Management is guiding to achieve 10% streaming margins in FY26, which is doubling the margins for FY25. One negative thing that we see, they're actually seeing the first negative free cash flow in 3 years. This is driven by payments related to prior periods and also elevated content spend on the blockbuster movies. So usually they have to spend first before they recognize the revenue. And at the same time, their capex remain really high at 3 billion US dollar because they continue to invest aggressively to expand their park projects and also to grow their cruise fleet. So management has guided stronger cash generation in the second half of the year as tax and content payment timing normalizes. Moving on to guidance, the management has guided double-digit entertainment segment operating income growth, which is weighted towards the second half, and they expect the streaming operating margin to be around 10%. The sports segment, they expect it to grow at a low single-digit rate, while experiences segment is guided to grow at a high single-digit rate, but it's going to come back-ended weighted as well. So most of the growth is going to come in the second half of the year because right now they're seeing a lot of headwind on international visitations at their domestic park, as well as because they just pre-launch and pre-opening costs related to their Disney Adventure cruise ship, which they just launched. They also just launched the World of Frozen at Disneyland Paris. And overall, they expect double-digit adjusted EPS growth, reflecting their improving operational leverage across the portfolio. We think overall they're seeing very strong blockbuster performance, so that continue to reinforce their ability to monetize the IP across all their different segments. And their streaming is now firmly profitable with improving margin. And importantly, Disney is investing very aggressively to extend its long-term growth runway, including major park expansion. They're basically expanding every single park that they have right now. And they have new cruise ship launch coming, such as the World of Frozen in Paris. And this alongside with them continuing investing in their streaming, we think we remain positive on their long-term earnings power. So we upgrade to buy from accumulated rating due to the recent price performance, and we have an unchanged target price of 130 US dollar. That's all from me. I'll pass my time to Serena.
Thanks, Helena. Good morning, everyone. I'll present Google fourth quarter 25 result. So the result actually exceeded our expectation with the revenue actually up 18% year-on-year to $114 billion, and PATMI actually increased 30% year-on-year to $34.5 billion. And this is driven by the robust performance for their core business segment, which is ad and cloud. The financial 25 revenue and PATMI were at 97% and 108% of our financial 25 forecast. So turning to the positive, we continue to see the very resilient AI-led performance for Alphabet because the search advertising revenue actually grew the fastest in 4 years. It's actually up 17% year-on-year to 63%. It's led by retail vertical. And YouTube ad revenue growth declined to 9% year-on-year, but it's still considered pretty resilient. And then it's 11.4 billion, and this is due to the decline is actually due to a strong ad spend during the US election in the same period last year. And as for YouTube, currently the annual revenue has actually surpassed $60 billion. So YouTube Shorts and Living Room continue to demonstrate quite strong momentum because the podcast viewership actually up 75% year-on-year, and Shorts currently now has like average of over like 200 billion daily views. So we estimate Google Ads revenue to growth of 17% year-on-year. This is driven by the improved ad efficiency and engagement from Gemini deeper integration into search. As for cloud, the business segment actually reported the fastest revenue growth since 2021, which is in 5 years. The revenue up 48% year-on-year to $17.7 billion. And now it has a annual run rate of over 70 billion. The growth was primarily due to the double GCP client base compared to the first quarter 25, and the larger customer commitment with the number of deals signed that worth more than $1 billion in just financial year 25 has actually exceeded the total number of deals they signed from the previous 3 years combined. And the third one is that they have a deeper client relationship with Alphabet because based on their current commitment, they're currently spending more than their initial commitment by over 30%. So in terms of the capacity, Google still expect a very tight supply condition in financial year 26. The backlog now has actually doubled on the year-on-year basis, currently at $240 billion. For this business segment, we actually expect 45% year-on-year revenue growth in financial year 26. This is supported by a very strong cloud demand and also Alphabet capabilities to monetize the Gen AI portfolio, which actually up 400% year-on-year basis, and also expanding operating margin. So besides the revenue growth, both core business segment actually reported a very strong operating leverage. The cloud margin actually rose very significantly to 30.1%. This is supported by strong revenue growth, and also at the same time, the continuous of Gemini model optimization, because the Gemini serving unique cost actually has been reduced by 78% year-on-year in financial year 25. And even for Google services, the margin also grew 290 basis point to 41.9%. As for the negative, going to financial year 26, there will be a higher capex according to Alphabet. They guided a capex range between $175 billion to $185 billion in order to support the model development by Google DeepMind. It also implies that capex year-on-year growth can increase between a range of 92 to 102%. We think that there might be some pressure on the short-term valuation because there will be a higher depreciation cost and also energy-related expenses, and also, of course, continuous hiring. There will be a higher AI talent compensation, but we believe that the impact should be offset by the strong performances in core advertising and cloud segment, and also supported by the currently a very strong positive cash flow. As for the Gemini, we continue to see a very strong growth potential because the Gemini model demonstrates a very good improvement in capability and also adoption. The company announced that Gemini 3 Pro, which actually launched it only November last year, it has already become the fastest adopted model, and currently they handle 3 times more tokens than the predecessor. And also Gemini 3 integration into search is also helps to boost the search engagement, because currently daily AI modes query per user has doubled since it launched in May 2025. And these queries are becoming more conversational and longer and more complex. And also for the multi-year collaboration with Apple, we actually think that it presents a significant strategic opportunity for Alphabet because powering Apple next generation foundation model and the AI features actually helps to expand Gemini footprint as the Apple has a very big active device base. They announced it currently is 2.5 billion. Yeah. So for Alphabet, we actually downgrade to accumulate rating because of the recent share price performance, but we raised the DCF target price to $395 from $340 because we believe that Alphabet continuous Gemini upgrade and integration should continue to support the competitive position in this AI landscape. Yeah, and then I think that's all from me. I'll pass the time to the next presenter. Thanks very much.
Well, I think Glenn is at DBS results. Let's move on first. Yep. So talk about first week results. So for their results, FX remains the drag for them as usual over the past year or so. Their performance has been very stable, but it generally has been impacted by FX. So take a look at their performance. At the DPU for the second half is 1.04 cents. So that's down 10.3%. For the full year, it's down 8.1%. Yeah, but this result was in line with our estimates. As the FX continues to hit their income. Yeah, so looking at the operating performance in local currency terms is generally very stable. So for Indonesia, it's up 5.1% year on year. For Japan, it's flat as they do not have any escalation. So it's flat year on year. For Singapore, there's a 2% increase. Yeah, so it's very stable operating performance in local currency terms. For the capital management front, their gearing is healthy, 42.1%. ICR also 2.7 times is healthy. Their all-in cost of debt is expected to remain at 4.5% this year. So for FY25, it's down 50 basis points to 4.5%. So generally, we are expecting it to be stable year on year. With 46.1% of debt hedge. So they have about 260 million loans that are due for refinancing this year, but the bulk of them, they have extension options, so they can just extend the loan by about 2 years. Yeah, so regarding the perpetual securities, if you recall, they have 60 million perps. And then a few years ago, like 2 years ago, they recalled about half of it. So there's about 33 million remaining. So they recalled or rather they redeemed this in full. So they do not have any perps remaining on the balance sheet. Yeah, so this perps, if you remember, was at a 4.9% coupon rate. Yeah, so for the negatives for them, rentals continue to be owed by MPU. So as of the end of last year, it was 6.9 million. But in January, they received first week received a 1.5 million payment. So the rental in arrears has fallen to about 5.4 million. Yeah, and for another negative is that portfolio valuations decline, mainly because of the depreciation of the foreign currencies again. So on the same store basis, it's down 6.2%. But if you look at local currency terms, Indonesia is up 1.4%. And Japan is roughly flat, just down slightly 0.7%. Singapore is down mainly due to lease decay, but Singapore's minus 5.8% is a very small percentage of their portfolio. The largest chunk is Indonesia, of course, from the Indonesia hospitals. Yeah, so for the strategic review, it's been on for over 1 year. So far, no material updates. They continue to assess all different options for First REIT. Yeah, so no any material updates will definitely update. But generally, from what we know, is that Siloam, they really want to push this sale ASAP, because every year, the longer they wait in local currency terms, Indonesian hospital valuations will keep increasing, and as a result, they'll need to fork out more money to acquire the properties. So they're waiting, or rather they're trying to push First REIT for the acquisition. And for the FX impact for FY25, the rupiah depreciated by about 5% year on year. So that really hit First REIT. But going forward, they plan to hedge at least 50% of FX. So previously they did hedge 100% of the Japanese yen and about half of the Indonesian rupiah, but those have already fallen off. So when they re-enter into new hedges, will be at today's rate. And yeah, going forward, the impact of FX could potentially be mitigated by the base 4.5% rent escalation for the rest of the portfolio, assuming everything remains status quo and no transaction is done for the Indonesian hospitals in the near term. Yeah, so no change in our call. We maintain our accumulate call, but our target price we lowered from 31 cents to 29 cents, mainly because of the FX impact. So that impacted our DPU. And our FX, our full year 2026 dividends, we are still expecting a 8.4% yield. So we still think this yield is 0.4% is attractive. But for capital upside potential, we think it's quite muted. So it's generally investing in First REIT for the high yield of 8.4%. Yeah, next slide, please. Yeah, move on to one pillar on the ground, CICT. Yeah, so for CICT, the performance was very strong, anchored by the almost 95% Singapore portfolio. So you can see at the right side, that is the income contribution. So the pizza or the pie chart is 95% contribution comes from Singapore of their FY25 income. Yeah, so their DPU, it was up 6.4% year on year. Second half was up 9.4%. That's mainly from the strong operating performance of Singapore. Yeah, and for occupancy wise, take a look at the bottom right, the chart. So it shows that portfolio occupancy right now is at 96.9%. Retail remains strong, 98.7%, and office 95.7%. So the office sector and retail sector in Singapore is really what drove the outstanding performance. So rent reversion for FY25 for downtown malls and suburban malls was 6.2% and 7.2% respectively. So as on average, it was 6.6% for retail, and for office also it was 6.6% for last year. Tenant sales also remain very stable, increased 1.2% if you exclude Ion Orchard, but if you include Ion Orchard, it's up almost 15%. Yeah, so the portfolio valuations were up 5.2%, but that's also partially because of the acquisition of Capital Spring. So in Singapore, it's up 5.1%, but if you exclude that on a like-for-like basis, Singapore is up just slightly under 1%. So that's also very positive. And for the outlook, organic growth will really come from the AEIs that they are executing. So they just announced the AEI of Capital Tower. So that's a new one, and currently they have some ongoing AEIs like Tampines Mall, Lot 1, Raffles City Tower, Galileo. So most of these are expecting a yield on cost of about 7%. IMM, the AEI is already completed. And going forward, they have a development project. If you saw the news, they won a site at Hougang Central site with their JV partners. So CICT will own and develop 100% of the commercial component of this site. So that's about 300,000 square foot. So they are looking at about 5% yield on cost and target completions within 5 to 6 years time. Yeah, so that is for organic growth. For the organic growth from the current portfolio perspective, we are expecting like mid-single digit rent reversion for both office and retail. And we do expect the cost of debt to improve by 20 basis points. So currently it's at 2.2%. We expect it to dip slightly towards 3%. So inorganic growth, we think going forward will still remain opportunistic, but we think it's better for CICT to just remain largely in Singapore, as we see the portfolio is really anchored by Singapore, and which drove the very strong performance, and share price performance as well is up over 20%. So as a result of that 20% increase in share price, the dividend yield has really fallen. So now it's at 4.7% despite the very strong DPU performance in FY25. Yeah, so that's all from me. I'll hand over time now to Hashim for OUE REIT. Yeah, thanks.
Thanks, Darren. Okay, I'll go through OUE REIT's results. So FY25 DPU of 2.23 cents. It beat our expectations by 12%. FY25 DPU rose 8.3% year on year. So that was mainly due to two reasons. First is due to a decline in their financing cost, and second, due to a very strong commercial performance. So their commercial segment showed strong momentum with like-for-like revenue and NPI increasing 3.9 and 5.4% year on year. And their OUE Bayfront JV earnings jumped 49% to 14.5 million. And this is mainly due to the flight to quality trend we see for grade A office assets. So the stronger commercial performance is largely due to the strong rental reversion we observed for grade A office. So for their portfolio, they had a rental reversion of 9.1% and a high occupancy of about 95%. And their passing rent is about 11% below market rate. So passing rent is currently $10.97 per square foot. And the market rate in fourth quarter 25 was $12.30. So there is a room for reversion there. And one third of Deloitte's leases is also expected to expire in end of 2026. And they're currently occupying 4 floors in OUE Downtown. So even if they do not renew their leases, we still expect for a strong demand and reversion potential, given that Deloitte is currently occupying the space below market rent. Second, their cost of debt has fallen significantly. It has dropped about 80 basis points to 3.9%. And this is largely due to a larger proportion of flexible rate debt that they have. So their fixed rate debt was about 67% as of September 2025. It crept up to about 70% as of end 2025. And compared to other REITs, this is on the lower end. And this allowed it to benefit more from the SORA decline. So it also used a portion of the Lipo Plaza divestment proceeds to pay off its debt. So its gearing fell from about 40% to 38.5%. And lastly, their Salesforce Tower acquisition, we view it favorably. They are taking a 20% stake that is going to be funded through reserve funding. So there won't be any extra equity fundraising done for this. So there is no dilution expected for it. Its current tenant, Salesforce, has a WALE of 5 to 6 years, and it's occupying the space at a below market rent. So we do see the potential for rental reversion going forward. For OUE REIT, their hospitality segment declined. So 5.9% revenue and 3.5% NPI decline year on year. But we think this is largely structural, given that FY24 had a stronger base year. And going forward, we expect more asset recycling from the REIT. So for instance, One Raffles Place, it has a yield of about 3 to 3.5%. And we expect it to recycle these assets into higher yielding assets such as Salesforce Tower. So currently it has a 20% stake once it acquires. This will serve as a pipeline asset if current owners exit the building. And because OUE REIT will have the preemption rights to first buy the stake before it goes to the market, we think it serves as a significant pipeline asset with a good yield. So with that, we maintain a buy rating at a price of 45 cents. OUE REIT has a dividend yield of about 6.2%, which we think is a very attractive yield in the market. With that, I will pass on to the next.
Thanks, Hashim. Good morning, everyone. I'll move on to the technicals. Yeah, so first one on S&P 500. Last week, it was rather flat, was down 0.1% on a weekly basis. So in terms of the chart, the price is still holding this short-term upward channel you see in black. So and also is still holding the key 100 SMA support, which is the purple moving average. So I think for this week, we're likely to still see some continued sideways consolidation, which we've generally been seeing since the start of the year. So the overall resistance likely to be at 6,945, 7,030, while support is likely to hold at 6,780 to 6,870 area. Yeah, next slide, please. Yeah, so next one, I'll talk about the Bitcoin ETF. So last week, we saw there was a sharp drop of about over 16%. So in terms of the chart, there was a very strong continuation after this bearish breakdown. Yeah, and in terms of the next support level, I think it will be somewhere around $7.47 to about $8.34 level. So that's about a 200 close to about 100% Fibonacci extension level when you take the highs on October last year, and also when reference it to some of the swing low levels from 2024 August about there. So that's potentially the next strong support area for the Bitcoin ETF. Next slide. Next one, I'll talk about the software sector ETF, IGV. So for IGV, last week there was a sharp decline as well, about down 8.6%. So in terms of the charts, for breakdown of some key supports at previously 98.70, $94.23 as well as $88.82. So currently it's nearing a retest of the lows that we saw in April 2025 last year during the Liberation Day lows. So the next strong support area I would think is around $73.12, about $77.14 area. So this area is a key area which was formed between about August 2023 to about August 2024 area. Yeah, so that coincides with a 200% Fibonacci extension level when you take the highs in October of last year. Next slide. Yeah, so this table just summarizes our technical calls initiated last week. So first one for Sunhawk is currently down about 0.7%. For Carnival Corp, it's currently up 3.6%. For DFI, it's currently down 0.9%. Sheng Siong is up 4.6%, and Delphi is currently flat, all as of Friday's close. Yeah, so that's all from me. I'll head over to the next presenter. Thanks.
Yeah, thanks, Zin. So, so we move on to Keppel's results. It was released on Thursday. So, as the title suggests, yeah, can you go back to the slide first? Yeah, so as the title suggests, they are giving more and growing more. They're giving more because they're giving special dividends and growing more because we think the growth should be also stronger as we go into 2026. Next slide. If you look at the results, it was within our expectations. And excluding M1 because the numbers are a bit hard to compare because they took out M1 results in 24 and then they of course took out for FY25. So the results so we had to strip that out, and then the results were generally in line with our expectations. The positives was the special dividend that they announced. The ordinary dividend is the same. It's about 34 cents, but the special dividend they're giving is about 12.7 cents. 2%, 2 cents cash, and then the rest is one Keppel REIT for every 9, which works out about almost 11 plus, I guess, almost 10, 11, 10 plus cents, sorry, 10.7 cents. The other thing is that they are also committing to give 10 to 15% special dividends, any of the assets being monetized. So we have the note later, but they have about 13.5 billion of assets to monetize, and they will pay off that 10 to 15% of that. The second positive was the growth in core operations. So you look at the table on the left in the red box, the infrastructure, real estate, connectivity. So this will be the so-called new Keppel. and that is growing roughly about 24%. What we do is you look at the table on the left, there's a lot of adjustments here, and because we have to, from the PATMI, which is the headline number, we actually have to take out all the valuation gains and then all the capital recycling, which is the gain on disposal. But then the headline number actually has the non-core, so we have to take out the non-core, which is like the REIT business and some of the real estate that they're planning to sell. So non-core is that 13 billion of assets they want to sell. So that is growing well. Infrastructure is going because the DSS. So DSS basically stands for sustainable solutions. So what they're doing is that they are doing operation and maintenance for especially waste to energy plants and so forth. So that is beginning to grow very strongly with a backlog of 7 billion of orders over the next 10 to 15 years. The other thing that's doing well is real estate. Partly, a lot of it was due to better REIT performance, especially Keppel REIT, and then connectivity did well because of Keppel DC and asset management fees. Because when Keppel acquired their data centers, they got this acquisition fee and disposal fee. More like acquisition fees. The negatives is the electricity spreads. So electricity spreads, basically the margins on power, which is also going to affect Semcon Industries. It is not like falling off; it's just normalizing. Because you're talking about pandemic type of margins, so they have to roll that off. They don't disclose the margins, but I think revenue. But what we can see is that revenue for electricity sales is down about 9%. In terms of the outlook, we lower our headline earnings because now all the headline numbers that you see from Keppel, they will include the non-core. So it's a bit, I wouldn't say messy, but it's a bit hard to kind of pull out the new Keppel earnings, which they will actually separate out in future. But just don't look at the headline numbers because they will include, like, if you notice here on the left, almost 200 million of losses from the non-core business, which they're planning to dispose. We raised our sum of parts to 1380 mainly because we raised our core capital earnings and also the PE multiples in line with the global peers. And then 2026 earnings will be strong because we are looking at asset management fees will grow because they just grew their funds under management by 8%. If you look on the left again to 95 billion. Lower interest rates will also benefit them because they are geared. I think the net gearing is about 9 billion. Cost cuts, I think they're committing to quite aggressive cost cutting. And the big one will also be the new Keppel Sakra Gen plant, which we mentioned, the 600 megawatt, which will raise the capacity by 50%. And then maintenance income from the Bifrost subsea cables and also the decarbonization and sustainable solutions, they call it the DSS. Next slide. So just to give you a flavor of some of the outlook, I think we mentioned this infrastructure. The core driver would be the new power plant, of course, and which they've already contracted out 2026 and 2027. So of course, if a new power plant, you definitely get earnings growth. I mean, you just throw in one big power plant to your earnings, and then the completion of the Hong Kong and Tuas waste to manage waste to electricity that those plants will also those plants will also contribute to earnings in 2026. Sorry for stumbling. Then for real estate will be asset management fees and lower interest rates. Connectivity will come. There aren't really much connectivity business, right? It's mainly a lot from Keppel DC, but on their own they will get the cable, which they will get operation and maintenance fees. And then asset management, like we mentioned before, the one to watch is of course the non-core. If you look at the last line here, they have about 13.5 billion that we mentioned. And then the key one will be the REIT, which is about 4 to 5 billion that they want to sell. They just give some highlights that the jackups are running and then they hope to recontract at higher rates. Next slide. I'll move on to our usual weekly, Singapore weekly. So for weekly, some of the key macro for us to watch for Singapore macro numbers is visitor arrivals. So visitor arrivals in Singapore is a bit soft. So this year, you look at 2025, you're looking at 22.2 million of arrivals. And then compared to, of course, 2024 was still a blockbuster as we came out from COVID. So like 21%. So arrivals are now stabilizing around the 16, 17 million number. RevPAR, which is basically, you can think of it like hotel sales, because it's revenue room rates adjusted for occupancy. That's basically flat now. Yeah. And then, but if you look at the third bullet point here, manufacturing is doing very well. So as we move into 2026, it seems that manufacturing activity in Singapore continues to be vibrant. So this is the new orders. It's a bit forward-looking because it's the best reading in 10 months. So it's like telling all the purchasing managers, how do you see your new orders? So this is the best number in 10 months, or at least the momentum. Retail sales is generally stable. Supermarket sales has been exceptionally strong because of the vouchers. And for the fourth quarter, you're looking at almost 5% growth. So this should benefit Sheng Siong's fourth quarter results because the industry is growing about 5%, which is huge. Because supermarket sales pre-pandemic normally only around 1% growth. The other peculiar thing you notice that we also added container rates because Yangzheng Shipbuilding share price have been kind of weak. That's mainly because expectations of the Red Sea reopening the Suez Canal. So all the container rates basically down almost 8-9% just last week alone, because everyone's preparing for the Red Sea. So once the Red Sea is open, you don't need so many container ships because right now all the container ships you need extra because you got to sail around which additional 2 weeks to sail around South Africa, which is the Cape. Yeah. And then right now, the Red Sea is also it's going to be cheaper to use the Red Sea, and of course, without so much business, the Suez they're going to charge cheaper rates apparently. So you should expect more containers vessels to use the Red Sea and don't need to go around South Africa. So this means the demand will shrink because you don't need so many ships on the sea, I guess. The other number that came out from the US, quite a bad number, which is the job openings. So that is the weakest in, I don't know, 63 months or since 2020. Yeah, I'll show you a chart later anyway, next slide. So in terms of our tactical views, our software analyst is on leave. But since this is the biggest talking point, so let me just share as much as we can on how we view the software. So like what Zane mentioned, software was sold down. Just in 1 week, some of the stocks were down 20% or maybe low teens, despite the rebound. And this is even after rebounding, I think, on Friday. So the concern right now is AI agents. So now the thematic now is that, or the prognosis is that AI agents can be created and can replace any application software using just the company database. So naturally, SaaS companies cannot disappear. I mean, you won't going to use agents to replace all the core software because most companies have very complex database, and then it's going to be hard to scale the agents for now. And more importantly, of course, there's security concerns. So you don't expect all the banks to start using AI agents. And I guess you'll be worried too if they do that. But what will happen is probably there's going to be a derating of margins and growth. So one derating on margins is, of course, SaaS, which is basically software on the cloud, like what we do on Microsoft now. We do subscription every month or every year. So software is basically one of the most profitable business because you get 90%. You can get as much as 90% gross margins. All you do is just put up the software development cost one time, and then you can distribute at scale. Like you subscribe to Microsoft right now is at scale, and it's almost zero cost to Microsoft. So that's why you can get 90% margins. But what the startups are doing is that they are using AI agents and pricing in on actual outcomes. So they're not selling seats or license. They are basically selling on outcomes. That means if I can achieve this task for you, for instance, get a sales lead, get a meeting with your sales lead, then I only charge you. And AI normally margins about 40% only because of the huge computing power that you need. So it's costly to do that. So that's the worry right now, that margins for all these software companies are under pressure as all these startups start to sell AI agents. The second concern over software is the addressable market. So right now, the worry is that software business will come down because if you use agents, you are actually targeting a bigger business, which is services. So basically, you're capturing employee wages, capturing wages like people like us, all the service industry, back office, and so forth. So the assumption is that if unless all the SaaS companies or software companies can use agents, then they will have a larger addressable market. So the key thing here is that if SaaS move from the software market, which is about 300-400 billion market, to actually a 13 trillion labor services, basically taking a share of everyone's wages, because you're selling services rather than software right now with agents. So again, this is the big pitch. I'm not saying that it will work. I'm not saying that this is the inevitable, but this is basically the pitch, and this is basically the worry that they have for software. So the opportunity for software is to become services, to sell services instead of software, because services is a bigger. I mean, replacing employees is a bigger addressable market than just software. Again, we are not prognoting anything. I'm not saying software or is good or bad, but this is basically we're just telling you what is the view out there in the marketplace. I'm not sure if it's right or wrong, but anyway, since there's such a huge sell down, we just want to give you some color on it. These are some of the events. We got DBS, the key one payrolls. We also have Singapore budget on this Thursday, announced on 3 p.m. These are some of the events. Next slide. Okay, this just to show you on the left is the manufacturing, the index, the surveys. So you can see that manufacturing activity is picking up strongly in Singapore. Probably globally, largely we think is semiconductors and hard disk drive. On the right here is basically arrivals is strong, but RevPAR, so hospitality isn't growing very strongly. Even though visitor arrivals has been climbing up stronger. This is one way to understand the chart on the right. Next slide. This is just container rates. Ignore the year to date. I think that one's a typo here. I didn't amend it. But anyway, year to date, container rates are down 10 and 16%, China to US or China to Europe. So this is negative for even the shipbuilders because a lot of Yang Zhejiang's orders are coming from container ships. You can see the rate is coming down. Pandemic, of course, you get that incredible high of almost 15,000. Now it's about, I think, 2,000 per TEU or per container. Retail sales, you can see the red line supermarket has been picking up, although a bit softening right now. Probably, yeah, because the vouchers are ending. Next slide. Then, this is the employment number. So the key one to look at is the red line here. So you notice the red line is the openings. So one way to understand this is like a proxy to labor demand. So labor demand is softening very fast. Basically, job openings or job vacancies. Then the blue line is basically the vacancy to unemployed. That means how much jobs available for everyone unemployed. So the number is shrinking to less than 1 now. It's lower than pre-pandemic. Initial jobless claim is volatile, so hard to read, but no major spike yet. But basically, what we are seeing is that US labor conditions is actually clearly softening. Next slide. Okay, thanks everyone. You can move on to Q&A.
Yeah, thanks. I'll take on some questions first. Why is AMD gaining CPU market share from Intel? Is it because of lower ASP? Yeah, so just to give a bit of context for those who are unsure, Intel's market share is about 70%, low 70s. AMD is high 20s. In terms of market share. So this high 20s has increased since I think 1 year ago it was 20%. Yeah, so AMD has been gaining market share because not really about lower ASP. If you see in terms of the most recent generation of PC CPU from AMD, which is the Ryzen 7, it is just slightly cheaper than Intel. I think about 5% cheaper than Intel's Core i7 CPU. But in terms of performance-wise, AMD's CPU has better memory performance so in terms of better memory performance, it can give gamers the edge in terms of efficiency as well as the kind of frames that they are looking at. But in terms of Intel's superiority over AMD, Intel is better in terms of kind of the parallel workload that can run. So because its Intel CPU has more cores and threads. So these cores and threads allows the CPU to perform better in terms of video rendering, video editing, such complex tasks. But AMD is still better in terms of gamers for gamers wise. So I think because recently over the past 2 to 3 quarters, gaming has been picking up in terms of the cyclicality. That's why AMD has gained this CPU market share, in my opinion. Yeah. How was Qualcomm's results? Yeah. Yeah, right. Shares drop after. Yeah. So in terms of the results, they didn't perform that well. Revenue was up only 5% year on year. Compared to the previous quarter, it was up like 10% year on year. So the revenue growth is decelerating. And this is because their Qualcomm Tech, their handset segment is being affected. It's being affected because their handset OEM customers, mainly from China, they have been reducing their inventory because of the spike in memory prices. That's why going forward, Qualcomm also provided a very weak guidance in terms of their handset revenue. They provided guidance that the next quarter handset revenue will drop by about 13 to 15% now because their handset OEM customers are reducing their inventory. Yeah, so I think because of the weak guidance, the shares also drop. Yeah. Yeah. There's a question. Please comment on Everglory's announcement on contract wins. How will it be reflected in the forthcoming results announcements? Yeah, so I think there's a big piece of news saying Everglory has won about $500+ million worth of contract in 2025. So their current order book stands at 700 million. So we do expect this 700 million to spread across 4 years because of the larger nature of the contracts itself. But we don't think that it will be an even spread across the 4 years. It will be a slow ramp up. So for example, first year, maybe 5% recognition. Second year, maybe 15%. Third year, maybe 20%. Fourth year, it will be the biggest. Yeah, so that's the kind of ramp up we should see. So in terms of how will it be reflected in the forthcoming results announcements, for 2026, we don't think that revenue or PATMI growth will be significant. But for 2027, we do think that there'll be higher growth in terms of revenue and PATMI. Yeah, so 2027, we do expect to see more growth from there. Yeah. I think that's all from my end for now. I hand over to my other colleagues. Yeah, thanks.
Yeah. Let me take some. How is digital core REIT and Ascender Street results? Yeah, so digital core REIT, their results actually wasn't too bad actually, I would say, because year on year, minus the 6 months absence of income from the Linton Hall data center, which contributes about 15% of income, they still managed a year on year stable DPU. So that is very positive for them. And going forward, they also just announced that they managed to sign a new cloud tenant to backfill that space. So that lease is expected to begin end of this year, December 2026. So that will likely contribute full year to 2027 if everything is on track. Because they still need to do some developments to the asset and such, spend some capex. So so generally very positive results for digital core REIT. Yeah, other than that, the core portfolio still will benefit from positive rent reversions. So in FY25, we saw rent reversion of about 35% for FY25. So that's a positive. Yeah, so that's for digital core REIT. Ascender Street, the performance also stable year on year, was just down slightly, like 1% on a full year basis. With 12% rental reversion for 25. So that is after like 4 years of positive rent reversion in the double digits for Ascender Street. So going forward, we do expect that reversions will moderate to about the mid-single digit positive rent reversion. And there are a few headwinds for Sandal Street, like the US office, the business-based portfolio might see some weakness, coupled with the continued vacancies in their Singapore BPs, like International Business Park right now, 50% occupied, Changi Business Park about 80%. So those are still kind of remains the drag. But they are in this considering to kind of revitalize the space, maybe do some CapEx, do some AIs to those BP spaces in Singapore to try to lift occupancy. Yeah, so that is roughly my take for those two. Is CapitaLand Invest and Prime's results going to be good this week? Yeah, so for CLI, we do expect some good results, especially from more transactions and probably seeding more funds and more event-driven income as well as the recurring fees from the fund management business and lodging management from the FRB. Basically, we expect it to remain stable, increase like mid-single digit probably for the recurring, and event-driven we expect it to be way higher with all the acquisitions and divestments that happened in FY25. Yeah, so that's for CLI. So we do expect some we don't think it'll be that great, but we think it'll be it will be decent for CLI. For Prime's results, for this FY25, the results might not see a turnaround yet because 10% of their income has yet to contribute to cash. So right now we are seeing at about 70% of their committed occupancy now is about 80%, but cash contributing occupancy is roughly about 70% only. So for FY25 or even for second half, you'll see likely this only about 70% contribution. So the 25 performance might not be that great, but at least they've already indicated that they will pay at least a 50% distribution for second half 25. So we've already factored out all of that in our forecast, and we think we are seeing about 3.5% dividend yield for FY25. So that's for Prime second half results. But going forward, we expect Prime's results to gradually improve as occupancy continues to improve, as well as the important one is the cash contributing occupancy. We expect that to continue to improve as well. So that is the important one that will really contribute cash and really lift the DPU numbers. So that is outlook. Yeah, but for FY25, we don't expect it to see a very significant recovery yet. But we do think a recovery will come in FY27. Yeah, so that's our take for those two shares. How does privatization of GoogleLand Malaysia impact GoogleLand shares traded on SGX? Yeah, the SGX counter, no real impact actually from the privatization from the Malaysia counter. Yeah, so limited impact on the GoogleLand shares that's listed on SGX. MIT recent results meet your expectations. Would you invest in it for its outcome next 12 months? Yeah, so for MIT, we don't cover, so we do not have a forecast. So we don't have a DPU estimate to compare that to. But generally for MIT, their results were very stable. They did manage to backfill some of the North American data center vacates, but going forward in the next financial year, we are seeing known vacates of about 5% of the NA data center portfolio. So AT&T is the largest non-renewal that we are seeing. So that is a kind of a drag and a headwind for Mapletree Industrial. So yeah, all eyes will be to see how they manage to backfill that. And we think for basically for Mapletree Industrial, there are North American data centers. We in our view, we think there is some needs for capex or refurbishment because it is quite dated. So yeah, there is some headwinds for that. But generally, the share price has not been performing well as compared to its peers, other REIT peers. So possibly it might be already priced in. Yeah, but the recovery will come if they manage to backfill all of these known vacates for Mapletree Industrial. Yeah, so that's my view. CICT refer to which share? CICT refers to Capital Land Integrated Commercial Trust, the largest S-REIT by market cap that's listed in SGX. For CICT, do you expect more headwinds from the US office sector, especially with AI adoption resulting in more job cuts? Yeah, so for CICT, they do not have direct exposure to the US, but if you are referring to job cuts and retrenchments that might affect office space, we don't think so, because generally CICT, the portfolio, 95%, like I mentioned, anchored in Singapore. So the Singapore office space remains very resilient. The rents, Grade A office rents, CBD Grade A office rents continue to improve. Like it's on an uptrend since COVID. So now it's at 12.30 for the latest quarter per square foot per month. And we think things like limited incoming supply there which is really very muted. In the core CBD area itself, there isn't any like Marina Bay area, there isn't any new supply. Yeah, so all this will help to support the demand and rent reversions as well. Yeah, so we don't think the US office sector that might have significant impact in the near term, at least for this year. Yeah, okay. I think I answered quite a few. I hand over to my colleagues for now. Thanks.
Thanks, Darren. I'll answer some of the questions about Google and Reddit. This one question says that on Google, with expected continued monetization of Gemini AI, will this cannibalize their Chrome search and advertising revenue? Yeah, thanks for the question. Currently, we actually haven't see the sign yet, because all of them are still showing quite a significant growth. I think it's an indication that instead of choosing, like preferring one over another, the user are actually adopting and trying all of Google services. For example, like for Gemini app, for this quarter, they still managed to grow 100 million monthly active user compared to the last quarter. And they also see a higher engagement per user. But at the same time, AI overview and AI mode queries still continue to grow. And for example, like AI mode, it actually grew like 3 times since it launched last year, like I mentioned it. And when it comes to metrics, cost per click still increased 7% year on year. It means like advertisers demand is still pretty solid. So that's why at the moment that we haven't really seized that, because of one particular part of it, then the other part of it, there might be a reduction of, or like weaker revenue, or like ad revenue growth. And then and then another question is about Reddit, and then is that why Reddit drops up after earning beats and raise. I think there are a couple of reasons. One of the reasons is because I think Reddit share price is a bit priced in. They do expect that the very is quite good when it comes to the earnings. And I think another one is because that they do see a US active user growth a bit smaller than they expected. And I think another reason might be there is a little bit of lack of conversation about the data licensing segment. But for Reddit, we still very positive about the company, because the main source of revenue, which is ad business, is still very resilient. Reddit managed to expand the advertiser base by 75%, but at the same time, even their existing clients, they still manage to increase their spending, especially for like small and medium businesses. They still manage to they still spending by like 100% year-on-year, on average. So, and as for user growth, Reddit currently they focus a lot of global expansion. So if you look at their user growth for international active user, it actually increased 28% in this quarter. So I think moving forward, monetization will still continue to be very strong for ad business because they will continue to have a lot of AI effort, and most significant one will be the Reddit answer, which is the AI powered search, and the second one is campaign, which is like the AI automation ad suite tool for advertisers. And then for data licensing business, because of the higher data demand, we still think that I mean for financial year 26, there will be more opportunity for expansion in this particular segment as well. Yeah. And then another question is what to expect from uh Spotify, Shopify, and AppLovin result this week. Because I covered AppLovin, so I'll just briefly talk about AppLovin. So I think for AppLovin expectation, I mean, for me, I personally will see that how well is the performance of Axon, which is um an AppLovin kind of like AI equivalent engine. So it's like to see that how it drives the demand, but we do still believe that the gaming will still be a revenue driver, but at the same time that we do expect to see some improvement in terms of is either revenue contribution or also like or maybe like a advertiser based expansion from other vertical as well, since they already did like a launch on as in like expansion to other vertical since last year. And then one of the vertical that we might be focusing on is e-commerce. I mean, like if this particular area, since they already have a very strong base on it, if they can manage to increase the revenue contribution or even like bigger brand or like advertiser base, they still might shows that AppLovin is having a more higher revenue stream potential and also kind of like growth momentum as well. Yeah. I think that's all from me. I'll pass the time to my colleagues. Thanks very much.
Hashin?
I can go through yeah. I'll just go through two questions. I think the first question is on the OUE REIT acquisition. So I'll just touch a bit more on it. So OUE REIT is targeting a partial stake in Salesforce Tower Sydney, about 20%. And this is they are in negotiation with Mitsubishi Estate Asia. And the acquisition is expected to be fully funded by the Lipo Plaza divestment proceeds. So there is an expectation that there won't be any equity fundraising, so it's not going to be dilutive. So why Sydney? The fundamentals is similar to Singapore. There is a shortage of office supply in Australia, especially in Sydney. The yield is also very attractive, just like Singapore. The yield on asset for office buildings, prime grade A office buildings in Sydney is about 5.5% to 6%. Slightly more than the Singapore grade A office supply. And the asset itself, Salesforce Tower Sydney, it's located right beside one circular quay. So it's a luxury upscale residential building. You can compare it to our stay at Marina Bay. So it's a very upscale residential building. And for people living there, they would obviously want to live, work where they live. And Salesforce Tower Sydney is the MBFC, so to say, of Sydney. And there is a strong demand for assets there. And we think because of their partnership structure that they currently have. So if any of the existing owners leave, they have preemption rights, which means that they have the priority to acquire the ownership stake before it goes to the market, and it serves as a pipeline asset for the for OUE REIT to acquire a larger stake at a more attractive yield. That being said, you might have seen the news, RBA, it increased their interest by 25 bips. And now this can be good or bad news. It can be good news because an increased interest rate might potentially reduce your portfolio valuation, and it may make it cheaper for OUE REIT to acquire the asset. So overall, we see the acquisition as a attractive acquisition. We are positive on the deal. I think second question was on the air show, and I will just touch on SIA Engineering. So we met with management, and overall, they reinforce their conviction on the aviation MRO sector. There is still a structural undersupply or shortage delivery of airlines. And one thing that stood out to us was that they are very bullish on the Indian aviation MRO sector. They think that there is a labor shortage in the space overall, and they feel that the market itself has a talented or English speaking talented labor workforce, which could be potentially a space where they could set up a MRO market for them. I think apart from that, there's another question: why are SIA and SETS shares rising quite sharply? We don't think there's any specific reason. SIA, I mean, this could be due to more investor engagement after the air show, and we think there isn't a specific reason for that. And I think that's all. I'll pass on to Paul or Zin.
Yeah, thanks, Asim. Oh, yeah, sorry, I forgot to unmute myself. Yeah, let me just run through some of the questions. What do you make of first quarter Hollywood's business update? There were no financial numbers given, but I think operationally things were generally still healthy. I think you can just think of them. I think the occupancy went up to continue to creep up almost 96.5, if I'm not mistaken. The second thing is they also still grew their bed count. But I think the more important thing is the pipeline. So I think the pipeline by this financial year can grow by almost 20%. So, but all this pipeline takes time to fill up. But I think they got properties opening up around 500 rooms roughly. Then that will probably boost their count by almost 20%. Yeah, that's one way to gauge the outlook. So generally still fine. No. I mean, there wasn't much information given, but generally operationally still strong. Why Singtel share price didn't react well after the STT GDC deal? Yeah, so the financial impact from this deal is not meaningful in the near term. So just to give you some numbers, so they lost just round it up. So they lost maybe 200 million net profit loss. They take 20%, so there's about 40 million loss. Singtel profit about 2 billion. So the financial impact isn't large. But the key thing is that they have a huge pipeline which sorry, just slip my mind, but I think it's like triple. They will at least triple their current capacity. So Keppel has a big STT has a huge pipeline of capacity that will triple the current existing capacity. Of course, it doesn't mean everything will be turned on. Some are really prelim, still haven't get. Some might be spec build. That means you speculatively build a data center, which I think Singtel will not go into that. But like we mentioned in the title of report, it's more a post 2028 story rather than right now. I think right now Singtel share price will be more affected by Bharti share price, which I think down 4-5% this year so far, together with the weak rupee. So I think Singtel more impacted by the weakness in Bharti Airtel rather than this. Food Empire, I'll hand it to Yikban for that, because what to expect from the budget this week? Heard rumors of reduced CDC. Yeah, I'm not so. Yeah, there will be some impact, maybe 1-2 percentage points of growth, but more important, Sheng Siong is to grow their footprint. But I'm more worried of Singtel's valuations. I think they're hitting almost high 28, maybe almost 30 times PE. I think that might be a bit too rich for me, at least. Yeah. Because the share price is really rallied, I think the last 1-2 days. So there will be some impact. Sorry, just to get back to the question, but they are growing their footprint, the store footprint by almost 10-11%. So maybe the growth, revenue growth, not maybe 11, 12, maybe down to 10%. So it's still very strong and resilient growth. So yeah, but it's more the valuations that concern me right now. What's your view on Thai beverage? Asia Pay I haven't seen for some time, but I mean for Thai beverage, there will be some optimism maybe because of the new prime minister. Then the optimism will be maybe the government will start to to pump prime. But my general view for Thai Bev is, of course, valuations is cheap, but of course we see a cheap valuation don't mean the share price go up, obviously. But I think earnings will stabilize. I think one thing I'm expecting at least is that the raw materials that is actually collapsing a lot, and then with the strong Thai baht, right? So I think they will probably expand the margins to offset the weaker top line growth. So I think earnings will be probably grow very low single digit. That's my expectations. And then just have to wait whether there'll be some, I don't know, pump priming or so forth. Yeah. Well, but I'm still expecting some growth because I think they mentioned packaging cost is down, sugar cost is down, molasses cost. I mean, sugar, molasses or sugar, yeah, the cost is all down. So, wheat cost is down. So all this is going to support the gross margins, and I think they're going to pull back a lot of their. They are famous for that. I mean, the marketing cost, they can slash marketing costs if the earnings are not strong. Because after they got 90% market share, so for spirits, so I'm not sure okay. Why is Collywood share price going down? I'm really not sure why. And especially at 60 cents, right? These are all new shares, and so everyone's cost is 60 cents. So I'm not sure. Have to ask Maybank. They are the ones who did the deal. What are some software stocks? I apologize. I think our analyst is on leave, so sorry, I have to wait for him to reply. What is the driver for ST Engineering price surge last week to 10? The news that came out was they announced new orders about 4.7 billion. So that brings their full year order book to I think 14 billion plus, which is a 50% jump compared to last year. So I think they're just it's just optimism because their order book just spiked up. So yeah. Sorry if this Oracle, yeah, we have to wait for Fami, yeah. Okay. There's a DBS, so I think Glenn is still in the DBS call. So sorry, I can't answer that. What's your view on Keppel after the results? Keppel C. I think you're talking about Keppel Limited. Yeah, I think we just presented, so we are still positive on it for reasons. Yeah. Have you changed your views on KRT? The market seems to have. Yeah. Actually, I haven't. I didn't listen to the call, so I'm not sure what happened to the but we were always cautious on Keppel Infrastructure Trust. Yeah, but I really don't know. I didn't really could listen to the call. Let me try and look through the results and try and get back on you. Yeah. Keppel Pacific, I'll leave it to Darren. What's the impact of Red Sea opening up, Yang Chichang? Share price doesn't look like yeah, so it's a negative. I mean, Red Sea opening up, like we mentioned, because container rates are collapsing, then their biggest customers are the container vessels. Um, I think today bounced up, but I think year to date is still down, I think. Yeah. You wrote an article last week that the new acquisition that Singtel took part with KKR, namely the global GDC, was actually running a loss. Wouldn't be a bad thing participation by Singtel acquiring. Yeah, it is a negative to acquire the loss making, but like we said, their share of the loss, maybe 40 million, Singtel 2 billion, is not going to impact them that much. Of course, there'll be some interest expense too, excluding that part. But the key thing is they're giving you that huge pipeline, I think, which is like, I don't know, 4 or 5 times. I don't have the exact number, maybe 4 times Singtel's existing data center. But what you should expect is, I think they might actually merge they might actually, my guess, they might probably list some of these data center assets, especially those in the ASEAN region. So you combine Singtel's ASEAN footprint, and then you take the ASEAN footprint of ST Telemedia, then you list it. I think that will be one way to monetize a lot of value. But I don't think you want to do it now. You probably at best maybe 2027 or even 2028. Then I think can realize then there'll be the biggest data center in the fast-growing ASEAN region. Yeah. So that will be one thing to expect. But all this is post 28, like we mentioned in my report. Sembcorp, what is the headwind preventing the trending up? The headwind is the results. So we're not expecting strong. The headwinds is the electricity spreads. So to give you some sense, I think electricity spreads may be dropping from $70 to maybe $30-$40. So that is the headwind for them, the electricity spreads. Then the contribution from Alinta will spike up the growth. Probably can only see it in the second half of this year, and then by the time they release the second half results, will be one whole year. They only like to do half yearly results, so that's why I think I can understand why investors don't need to rush for this stock. My target price was 710. Yeah, but the other thing I think the share price could move will be if they list their India renewables, which I mentioned before. Although the Indian stock market isn't doing well so far, but I think they will get better valuations. So I think maybe that's why investors are in no hurry to go back into Sembcorp Industries. I mean, that's my opinion. Dividend yield for Keppel is quite low. Moving forward, how much more potential special dividend? If you analyze it, I have no idea, but to hit their 13 billion divestments every year, they have to hit. I mean, it's just basic maths. Almost 3 billion of divestments a year. So if you do 10%, so about 3. So it's about double. The special dividend should be doubling the current rate if they can manage to hit what they do. Because they divested 1.6 billion. So 3 billion is double that. So it could be over 20 over cents if the special dividends, if they can meet their divestment targets. One of it is like Keppel South of the office building. Yeah, sorry, just to digress a bit. Delphi, I haven't seen Delphi for so long. I'm not sure who went for the meeting, but yeah. Keppel Infrastructure making a U-turn. Yeah, is this observation correct? Yeah, sorry. Let me go and look through the results and the call again. I didn't hear it. Any particular reason that all tech share price is falling? Has the fundamentals? Yeah, I think the share price is weakening. Firstly, there hasn't been any major news apart from the results. The ringgit, the strong ringgit might impact them a bit. I think because they might probably hold some US dollar holdings, and then the trade debtors they have is usually US dollar, so that might impact them a bit. But we think this is a good opportunity now, or maybe a strong opportunity, because we think you haven't seen much contract announcements by them, because I think they're pivoting towards getting a recurrent income business, setting up joint ventures to not only build but also to take a stake, so that not to continue relying on contractual earnings. So I think that maybe takes some time. So that's why you see a bit of not much news coming up. But we're still very positive on this company, and having dropped from the peak, I think one something probably is a good opportunity for everyone. For Keppel PE re-rating, could you kindly share what's the rationale for this and what's the historical PE for sectors? Yeah, it's going to be hard to use Keppel historical PE because the historical PE for Keppel included the Citrum results. So we are valuing Keppel based on the asset management business, and then we use a PE about 20 over times, which is actually, sorry, I'm just getting the right, which is I'm just using Brookfield's valuations, which is about 27 times PE, and then putting a valuation on the utilities, the power business. And then that's how we get the valuations. Very hard to use PE right now. The PE will look very high because in the earnings, they include the losses in the non-core business, which they're planning to divest. So of course you can say, oh, you're still losing money, but we actually separate it out because they're going to sell it anytime. So to add that into the valuation and pull down the whole group, is a bit unfair because what if they sell off everything, then suddenly you have to re-rate everything. So that's how we value it. And which Singapore companies will benefit? Yeah. So for us, we are most positive on Franken as a way because we think the semiconductor. I think we talked about this the last 2 3 weeks, but only just to repeat. So for Franken, we are positive on Franken because I think the biggest customer, let's say that the next 3 years I'm going to spend a lot on, which is TSMC. So TSMC has mentioned that they are going to raise their capex significantly the next 3 years. So they did hinting to you that to to buy a lot of equipment, and this will, like we mentioned before, going to benefit ASML and then of course benefit Franken. So our way to play the manufacturing for us is Franken, I think. Yeah. We talked about it a few times, but anyway, yeah. You can read our report too. Keppel share price have run up too far ahead, even though it says saying special dividend. Will there be a windfall? What sort of yield are we looking at? Yeah, actually, like the previous question, the yield isn't like super high, I mean like 12%. Yeah, but I think it's just, I think why Keppel is trading at the more premium valuations is because they give investors a lot of visibility. At least for this year, I think 2026 will still be a very strong year operationally, and they're going to do all this asset monetization. I think their way of guiding investors, telling you I'm going to sell all these assets, I'm going to give you special dividends, I'm going to do another 200, what's left, I think almost 200 million left for share buybacks. So that gives investors visibility. But like you said, the yield per se isn't high. I mean, it's like 30 over cents. Yeah, together because of the share price, together with that, it's almost 50 cents. Yeah. But if they do this big special dividend, it might jump to. Yeah, so the special dividend makes investors excited, but like you said, no, it's not going to move the needle in the very short term. Because like what's happened to DBS, right? You give that's why DBS don't give so-called special. You give special dividend 50 cent, then your share price dropped 50 cent. Yeah. But what is different for Keppel, they did it very smartly, is they are guiding special dividends almost for the next 5 years until 2030, 2026, 27, 28. Yeah. So I think that's the difference. Their special dividends is almost like 5 years special dividend. So if that makes a difference. Otherwise, special dividend, yeah, up, give you 50 cents, then the share price drop 50 cents, and then back to square one. Okay, I think the rest I'll leave it to Darren to answer, like this Keppel and Keppel DC. Yeah, thanks.
Yeah, thanks, Paul. What is Philip's view on Keppel Pacific changing its asset manager? Yeah, so for that, we don't think it will have much significant impact. So because first of all, Core they plan to shift the current team over to the new place once it's finalized. Yeah, so that is from what we are aware. So the asset manager is expected to transition, that the whole team, the people will move over. So the risk seems low. And for financial covenants or any breach wise, at this point in time, we don't see any risk because or rather it doesn't really any so-called financial covenants or prepayment clauses tied to changes in management. It's more for the sponsor and not so much the asset manager from what we are aware. So we don't think yeah there are any significant much impact. But yeah, of course you have to await the news of the new manager, and yeah, there is some transition period. Yeah, but generally our view is not significant impact. Yeah, as the current team will likely be shifted over to the new asset manager. Keppel DC results improved with 7% increase in DPU, yet the stock stayed flat. Any reason why Keppel DC is not picking up in spite of ramp up data center driven by AI? Yeah, so Keppel DC despite the fact that their DPU really shot up so much, their dividend yield, if you calculate, is still under 5%, so it's about 4.8% based on current share price, which is Yeah, so it's around slightly under 5% for the current dividend yield based on the current share price of $2.24. So any reason why it's not picking up is part of the ramp up in data center driven by AI. Yeah, so what you need to be aware is that Keppel DC is still based on a property leasing structure. So they lease the tenant, then the tenant will pay a rent. Most of the time is fixed with escalations. So it's not really like your Nvidia where you expect like three digit 100% growth year on year or such. So yeah, we definitely do not expect the share price to run that far. So as after all, it's still a REIT and it's still backed by rental income, which is very stable, flattish type of income. So not much. I mean, there is growth, but you cannot expect so high growth, right? Like three digit percent. For rental reversion wise, they did have some very strong growth, 45%, but that is just for the portion of leases that are renewed and not the whole portfolio. So we can't really expect that 45-50% growth year on year for the whole portfolio as well. So, and then after all, as a REIT, it's still um, more of a dividend yield stock, so we can't really expect much share price upside, which is why I think my recommendation, yeah, my target price right now is $2.37. So share price upside, we don't think there is a lot of potential. After all, it's also trading at like 1.3 times book now. Yeah, hope that answers the question on Keppel DC. There's a question regarding the merger of CapitaLand and Mapletree is directed to Paul, but I'll just share a bit of my view on it. We think it is likely that it might happen, but it's going to take a while, definitely more than 1 year, because it's very complicated transaction. There are so many listed entities and that which have overlapping mandate, so it's also like the kind of breaches the anti-competitive laws or whatnot. So yeah, that is not sure how that will happen. And also there are a lot of private funds also. And if that the merger happens, well, it's going to be very messy. Yeah, so if something like that happens, likely it will take a few years for it to complete. Yeah, I mean that's why we're not sure whether Paul got anything, and I'll just leave it there. For CLI quarter to quarter 2025 result is if it is lower than quarter to quarter 2024, will it affect 2025? And I'm not quite sure what this question means. For CLI quarter to quarter 2025 result is lower than quarter to quarter 2024. Will it? Yeah, definitely if the fourth quarter 2025 result is not as good or lower than the 2024 number, definitely it will impact FY25 number, as fourth quarter is one quarter of FY 2025. Yeah, sorry, I'm not quite sure what this question means. If you could kind of type what you mean or explain what you're trying to say. Sorry for that. Why Freya's Centrepoint Trust share price dropping despite the result is good? Yeah, this one I don't really have any good answer for you. Yeah, why the share price dropping despite the result is good. Yeah, I don't really have a good answer for you. I don't see any news. But generally we still expect FCT to have like at least a mid-single digit positive rent reversion. So that will drive performance, and they do have some AI to help to drive organic growth as well. So we think that will set as a stable base. Yeah, other than that, yeah, they're paying about 5.6% yield. So which that is 5.6% yield is currently in slightly better than some of the peers like CICT is, as I presented earlier, is trading about 4.7% yield. So it's slightly higher. So yeah, other than that, I don't really know why it's Where the question disappeared. Yeah, I don't really know why share price is dropping. Yeah, but we have target price of $2.74. Uh, yeah, I think that's all for me. Yeah, I don't have time to Glenn to talk about the SGX results and possibly answer some questions.
Yeah, thanks,
Yeah,
Glenn.
thanks.
Yeah, hi, sorry everyone. I just came back from I just came off the DBS call. Yeah, so just let me go through the SGX slides first. Yeah, Ivan, could you move back to the SGX slide? Thanks. Yeah, so this just will be covering the SGX results. So they released their first half FY26 earnings. Basically, it met our estimates, at 51 and 50% of our forecast. Key highlights being that their core operating revenue growth was quite strong. You look at the equities, which was up 6%, and also the FICC, fixed income, currencies, and commodities, was up 14%. So this helped to offset the drag from the treasury income, which we did see coming. It was down 14%. In terms of their dividends and DPS, interim quarterly dividend was at 11 cents. So this is in line with their guidance of increasing it by a quarter cent per quarter. First half DPS was at 21.75 cents, so up 21% year on year. They have maintained their guidance to continue to increase their DPS by a quarter cent every quarter until FY28. So FY28 means we're looking at calendar year will be mid 2027. Yeah. So so I went through some of the key highlights. I think the main negative was really the treasury income. It was down 14%. Even though management did mention that there was an increase in collateral balances, so we don't get to see, they don't disclose what's their collateral balances in the mid-year results, but they did see some increase in collateral balances. But the reason why treasury income fell by quite a large amount is because of the fall in interest rates. Yeah, so we do expect this to continue, like this trend of treasury income continuing to decline as interest rates are cut further. In terms of the outlook, their volumes have accelerated healthily in the first half of financial year 2026. SDAV was up 20% year on year, whereas the DDAV hit a half-year record of around 1.35 million. So this was up by 7% year on year. It was really boosted by two things, mainly the Trump trade volatility that we saw in November, and also the $5 billion EQDP, which did help to lift cash equity. So I think that helped to answer, I think, one of the questions here that came in. Yeah. So their OTC FX is also showing healthy growth. It's continuing to grow. The first half average daily volumes of the OTC FX was up by 32% year on year, and it reached 180 billion. So they didn't really give any new guidance or targets for this ADV for OTC FX. I think previously they gave it like about a year and a half ago was 100 billion. They well exceeded that already. But they did continue to guide for the OTC FX in the medium term, at least, to have a mid to high single digit percentage contribution to EBITDA. So I would guess medium term is anywhere from 3 to 5 years kind of timeline. So currently in the first half, they are contributing 5%. In FY25, it was also 5%. So we'll be highly looking at it to grow further, and we could see, hopefully reach maybe 7 or 8% by the time maybe FY27. Apart from the other guidances that they gave, it has all been maintained for FY26. Expense growth of around 4 to 6%, and also the capex of 90 to 95 million. And this is mainly to continue to build out the OTC FX business, and the higher staff costs also due to salary increases. Yeah, medium-term guidance is also maintained, so they're looking at revenue growth of around 6 to 8%, and also like I mentioned, the OTC FX. And lastly, the guidance has been maintained for the dividend per share quarterly increase of a quarter cent. Yeah. We maintain and accumulate with a higher target price of $18.30. The OTCFX business will continue to scale, we believe, which will be driven by the digitalization and the platform stickiness, and also as they continue to build it out more and more. And the three things that we see driving volume growth in 2026 will be the EQDP inflows. And second one will be the Trump administration trade policy uncertainty, which will drive up volatility. And last but not least, the Fed's monetary easing cycle, which will lower interest rates, will continue to boost volumes in 2026. But the one big headwind that we see will be the treasury income, which we believe it will continue to decline going into the rest of the year. Yeah, so yeah, since I'm here and I think I can answer some questions, someone also asked what constitutes the treasury income. So it comes from the collateral balances that they have, right? It's over 100 billion. And what they do is that they will place this, into very secure sort of products like in government treasuries or with fixed deposits, and then they earn that margin, right? So that's how they get their treasury income. And it's the reason why it's declined because interest rate decline, like you and me, right? We try to put in a fixed deposit now, we're only earning maybe at most 1%. So that's why they see it drop so much, because it has to be very safe products that they place it into in order to protect their customers' money. Yeah, so what's the impact of the SGX tie-up with NASDAQ? Yeah, so for the NASDAQ, how will it benefit NASDAQ more versus SGX? Since more Singapore and regional companies may choose to list on NASDAQ with much higher liquidity. Yeah, I think the main difference, when you have this NASDAQ tie-up, right, they call it the global listing base, is because it will be up and running fully in mid-2026. So what they are trying to do is to not get companies that are just US list, like just located in the US, right? So they want to find companies that also have presence in Asia, in ASEAN, and then these are the companies that they're looking to attract. So they're looking to attract very high growth companies, and they are able to tap both the Asian and global investor base. Yeah. So far, they are looking to attract some of these companies to IPO by hopefully by end of 2026. Yeah, so that's the main difference with listing on NASDAQ, where in SGX, you are able to get I guess much more presence in the ASEAN and Asian region. Yeah, so I think I answered the question, why would companies want to list on SGX? Really because of that presence in Asia. Yeah, I think there's a few questions. I think someone asked about hold on, let me see. Yeah, I think Ian asked big pullback on DBS share to less than $59 after Q4 earnings results this morning. Any thoughts on DBS outlook for the rest of 2026? How about outlook for OCBC, UOB? Do they suffer the same fate? Yeah, so I wouldn't call it a big pullback. If you look at, if you pull it out longer a bit, it's really just a small blimp. It's still at near record highs in terms of their share price. So their Q4 earning results, some thoughts on it, just very brief thoughts because I literally just came from the call. Their outlook has not changed. The guidance has not changed at all. So they are really just guiding for earnings to come in below 2025 levels in 2026, right? Net interest income as well. And the reason why they can maintain and sustain this is really from fee income growth, which will be pushed up by the wealth management, and also a possibility of GP writebacks. So what we saw in 4Q was they had a big NPL, right, in Hong Kong real estate, and that pulled down their earnings quite a bit because they also had to write back some GP of 200 million. So that's how they balanced out the provisions in terms of for fourth quarter. Yeah, so that's the only thing that we saw, actually was the biggest negative, I guess, for DBS in the fourth quarter. And I guess without some I mean, that's the reason also why there was a slight pullback on DBS share price. In terms of OCBC and UOB, UOB, they already pre-provisioned a huge amount, right? 600 plus million in the third quarter. So in the fourth quarter, I would say it's a bit more unlikely that they will, have such a big provisioning again in the fourth quarter. And they said that it would be, and I also believe so that that was they were preempting people so that at least in the fourth quarter they won't have to provision so much, right? But for UOB, the biggest drawback for them and the biggest negative for them is how fast can they grow their fee income. I think I've been saying this at least for the last few weeks, right? Is that UOB's fee income growth and more particularly their wealth management growth has been very weak, even though they have put in a lot of money and effort and time into expanding their ASEAN reach, right, into the ASEAN 4 countries. Right? They bought over the city assets. They haven't reaped any rewards yet, right, from the expansion. And growth in wealth management has been very weak, right? It's been like low single digit or even a slight dip in the third quarter. So that will be the main differentiator, because the other banks like the OCBC and DBS are actually showing very good growth in wealth management. So that will be the biggest differentiator for UOB if they can turn that around. For OCBC, it's been very strong in their wealth management. I think they are able to continue growing it because they're capturing different revenue from different geographies as compared to DBS and UOB. Yeah, so I think OCBC and UOB, if they don't have any big provisionings in the fourth quarter, I think they might OCBC at least might perform better than DBS, but UOB is really what's the direction of their wealth management arm, because that is the main growth driver now for a lot of the banks, because net interest income, it's been in negative area for almost a year already because of the lower interest rates. So if your wealth management can help to buffer that decline in net interest income, and of course, the provisioning cycle will also be like where are they if they have provisioned properly. Yeah. Oh yeah, and then for DBS also, now that you mentioned I'm talking about provisioning and allowances, DBS still has a huge amount of around just double check my figures. Yeah, they still have 2.4 billion in management overlay. Yeah, so it did dip slightly, from 2.5 billion the previous quarter. Yeah, but this is management overlay that they have been saying multiple times that they could write back. Right, we see, I think, 100 million write back already in the fourth quarter. Right, so in the first quarter of 2026, we might see them write back even more. Right, and if there are no big NPLs, then this will just go straight to the bottom line. Right, and that could be the I guess the game changer for DBS. Yeah, someone asking which companies will be listed on Nasdaq. Where can we find the list? Yeah, I don't think they will give the list yet until it's confirmed. So for the listing wise, they are only looking, I think, by end 2026. Yeah, so they are still in the pipeline. Yeah, it's one long question here. There's two questions here. Hold on, let me check. Yeah, it's the same question, sorry. So they're asking, what do you think the valuations are stretched compared to historical PB and PE? What are the earnings catalysts if NIMs continue to drop? And would there be PE re-rating upwards for Singapore banks going forward given their financial strengths and strong digital push? Yeah, so the valuations are definitely above the 10-year average. Right? If you look at 10-year average, for DBS, it's around 1.45. Now it's currently at 2.4. I'm looking at the PB. OCBC is 1.5 compared to a 10-year average of around 1.2. And then UOB is still the closest, right? 1.2 compared to 1.1 plus. Yeah, so they are definitely at the upper end, especially for DBS. For DBS, because of their clear dividend policy, which is why they're given such a premium, right? They're the only Singapore bank that really are able to tell everyone, we are going to give you this absolute amount, and how much more will it be going forward. And also their capital return policy is still the clearest and the longest guidance as compared to the other two banks. For the earnings catalyst, like I think I said it earlier also, right? It will come from the wealth management fees, right? So how well they can grow wealth management and their AUM and also bring in net new money will be the biggest catalyst for earnings, right? So we see DBS really giving, I think their wealth management grew by 14% year on year in fourth quarter, right? And for OCBC as well in the third quarter, you saw that their wealth management fee growth was very strong. But on the flip side, you look at UOB, they did that provisioning, but if you remove that, their wealth management fee was also very weak. Yeah, and the other one would be the deposit repricing. So deposit growth is also a very big catalyst for the banks. In terms of DBS, it's they're the first to release, so they did say that for 2026, deposit growth will not be as strong as 2025. The main reason being a lot of the T-bills came off in 2025, so they just place it back into CASA, which is what grew the fastest. So we don't expect that deposits will grow as quickly in 2026 because the T-bills take-up rate was not as high as it was in 2025. Yeah, so the flow through will not be so much. Yeah, in terms of digitalization, I think DBS said, it was mentioned that they had 1 billion of, forgot the main words they used, right? It was economic value from AI, right, and digitalization. Yeah, and it came very broad-based, right? So they took it from like new to bank customers, account opening, KYC. That's how they got this 1 billion figure. But when asked further, they couldn't really pinpoint it in any in like the financial statements. There was no way to take out this 1 billion. So it was just, I guess, their best guess in terms of where this 1 billion came from. So it can really be from anything. But the main key point is that they have not sort of lowered headcount in order to get this savings, right? So it's just improving things and making it faster. Yeah. So I guess that's how they will be having that strong digital push that you are mentioning. Yeah, so management overlay is on top of the general provisions. Right? It is separate from, sorry, someone asked, management overlay, is that general provisions? Yeah, it's on top of general provisions. So they do have general provision, and then on top of that, they have this management overlay. In DBS is really the only bank that mentions explicitly how much management overlay they have, right? That they have set aside. So it's quite obvious, like how much earnings it can contribute to if they release some of this or more of this. So it's 2.4 billion. Can you imagine if you just pull it out, right? They just release 200 million every quarter, right? They can do that for 10 quarters, right? Or estimate roughly about 10 quarters, and that will straight away flow to bottom line, and you can see their earnings actually improve by 200 million. They did about 100 million odd in fourth quarter of 2025, but then it was offset by that increase in that specific provisions. Yeah, so the other two banks don't mention at all how much they have in management overlay, but this was way back. They have been building this management overlay when COVID hit. So for about 5 to 6 years now, they have had this management overlay. Yeah, someone asked, DBS announced 66 cents dividend for the coming quarter, correct? Yes. So it will, excuse me, it will be because they had that step up, ordinary step up in their ordinary dividend. So it will be 66 cents, and then you have to add on let me double check what's the dividend. If I'm not wrong, it's 66 cents, and then they have another 15 cents capital returns. Right, so it's not just, if you're looking at ordinary, yes, it's 66 because they added 6 cents to the 60 cents that they in the third quarter. So it'll be 66 cents, and they will 66 plus 15. So we're looking at 81 cents for fourth quarter, and then in the next 3 quarters, it'll also be 81 cents. So we were, they were asking whether or not this 6 cents or the 24 cents ordinary step up will continue into 2027. Yeah, so it will actually kick in the fourth quarter of 2026. Whether or not it will continue, but there has been no indication. So they didn't say no. They never say no, but they never say yes either. And it really, in their words, it's very dependent on the financial performance. I mean, I guess everything is dependent on financial performance. So I think they will only give. My feeling is that we will only get an indication of whether they will step up again somewhere in their first half results. That's when they will usually announce if they will be continuing with this 24 cent step up. So if they do, that means we're looking at 66 plus 6 in the fourth quarter of 2026. So that will be 72 cents in fourth quarter. Yeah, but I strongly believe that they will be able to do so because they are still accruing quite a bit of capital, even though earnings are relatively flat. Right, their CET1 is still at 15%. The last year was 15.1%. So you need dip by like 0.1%, even though they are returning so much capital. Yeah, so someone asked, since I'm on the dividend topic, let me just go to that as well. Yeah, suddenly a lot of questions on DBS, they are coming in. Yeah, total dividend for DBS for 2025 will be $3.06. If you're asking about 2026, let me just do some quick math. So assuming that they do step up again in the fourth quarter, right, we're looking at $3.30 of dividends for 2027. Yeah. So $3.06, 2026, $3.30. Yeah, so it'll be 81 cents, 81 cents, 81 cents, and then 6 cents add on, so 87 cents. Yeah, so it's $3.30. My math is correct, yeah. 81, yeah, correct. Yeah, $3.30. That's the forecast if they do step up again in fourth quarter of 2026. Yeah, I'll just answer these two more before I hand it over. Oh yeah, sorry, the time has flown by. Yeah, besides the 3 Singapore banks, which brokerage? Yeah, okay, so I don't think I'll be able to answer this. Yeah, I'll skip this one first. Maybe the last one I'll take is DBS is sandbagging on the management overlays, provisioning in order to forecast and give great earnings later. Yeah, that's a possibility. That's why they keep saying that possibility to write back, right? To have GP write backs. But it's understandably so because net interest income is not doing very well because of the interest rate environment, and also deposit growth, especially in 2026, it will not be as strong growth as it was in 2025. So that will also hit their net interest income. And wealth management can only buffer it so much because majority of their earnings and revenue still comes from net interest income. Right? And then loans growth can help to buffer that a bit. So wealth management and loans growth and deposit growth will help to buffer that a bit. But if you look at it overall, the only way they can actually improve earnings is either by one, cutting OPEX, which they have sort of sustained a bit the growth, OPEX growth, and also by releasing a lot of this GP overlay that they have. Yeah, okay, sorry, I didn't realize I took up so much time. Yeah, I'll hand it over to the rest of my colleagues. Thanks.
Yeah, thanks, Glenn. I think I will just try to take a few key questions before we end the session. So I'll just focus on some of the repeat questions for the TA. So first one I see is on Keppel. Let me just try to share my screen again. Yeah, so first one on Keppel, I think overall still a very strong momentum recently. Also managed to hit the target for tanker buy call. So for now I think it's a bit high at the resistance area of this uptrend channel it has been trading in. So previously at this level we might see some sort of a sideways movement over here. So for now I think support will be around like I think will be around 1160 to about 1180 over here for now. It might do some a bit of a sideways, or you might find some support on the 5 SME level as well. Next one is another one I see is Sembcorp Industries. Yeah, for Sembcorp, I think overall still nothing much going on. Still just quite sideways with the old resistance over here at 613 to about 620. I think still holding for now, and yeah, support is still generally holding around $6 about there. So I think we'll still see a bit of a sideways for the time being, unless there's a breakout above 620. Yeah, next one is I also see SIA Engineering. Yeah, for SIA Engineering, I think for now share price still looks a bit weak. Over here there's a bit of some bounce recently, but I will still expect some resistance to come. For now should be this 20 SMA around 342 to about this swing high over here 346. Can be some resistance over here, then share price might do some sideways over here for now. And in terms of the weekly, also currently trading below all the 5, 10, 20 SMAs on the weekly. Yeah, then today we tested the 5 SMA 339. So in terms of near-term supports, maybe around 332 to 335. I see one more. Yeah, I'll just try to go through one more. Like Singtel. Yeah, for Singtel, I think overall, yeah, still I think it's still a strong uptrend. Just some pullback recently after price tested this previous high around 486. So some pullback over here. I think price will be able to find some support at this 470 level. So this is the 10 SMA level, as well as this swing high. So there's 2 level of supports over here. And midterm, in the short term, maybe some resistance around 484. Yeah, to upper Bollinger Bands around 487 for now. So perhaps I would think some sideways consolidation after a run up recently. Yeah, so maybe it's 470 to 485 around here. Some sideways move. Yeah, so I will stop the TA over here. I think there's still quite a lot of questions. So apologies we are unable to take all of them in view of time. But if you're interested, I think tonight there's a TA webinar at 8 p.m. So feel free to dial in, and so you can feel free to ask your questions. Yeah, so I think I'll just stop sharing my screen. Yeah, thanks everyone for tuning in and also for all your questions. Yeah, just to note there will be no webinar next week because of CNY. Yeah, on behalf of my team, I just like to wish everyone a very prosperous and healthy Chinese New Year ahead. And also, if you're interested, we have 2 corporate insights webinars this week, which are Elite as well as Prime REIT. So feel free to dial in if you're interested to hear more about them. Yeah, so that's all for today. Thanks everyone, and hope to see you again in the week after next, which is 23rd February.